to another coffee hour. All right, got my coffee here. Today is an espresso with deep chocolate flavor. All right, it's actually really good. This is from a Thai, some type of Thai roastery here in Thailand. Actually really good coffee. So really enjoying it. Today, I got so much to talk about. This will probably be one of the most important videos that I ever put out. And I think a lot of you guys are going to get a lot of value from it. Happy Valentine's Day to everybody watching. If you're watching this video, go spend some time with your wife or your husband and wish them a happy Valentine's on my behalf. So with all that out of the way, guys, let's get into the stream because we're going to be covering a lot. We're going to be talking about NAV erosion, right? What is it? Does it affect you? Is this something that the boogeyman created? Is it the boogeyman? Because there is no real textbook definition on NAV erosion. There was this was not really a financial definition up until recently. I never came across it until Covered Call ETFs became all the rage and became very popular. You know, NAV erosion just wasn't a thing. So we're going to explore what is NAV erosion, how it affects ETFs, how it affects you as the investor. We're going to dive deep into this stuff. And we're also going to be looking at Covered Call ETFs. We're going to be comparing a few as examples. And then I'm going to talk about this strategy known as ETF stacking. All right. It's not a term I coined. I'm not actually sure where I got this from. But ETF stacking is what we're going to be covering. And ETF stacking is basically what we're going to look at with Covered Call ETFs, like how to properly do an ETF stack. All right. So we're going to cover all of that and more. So let's get into it, guys. All right. So there is no shortage of videos on NAV erosion. You can go to YouTube, you can go to Google and just Google these things. And there's no shortage of videos. And some of these are from people or channels I've mentioned to you guys. Passive investing. Again, I've watched his videos, so shout out to him. Retire on dividends. Shout out to him. Again, I don't think I saw these ones or income architect. So, but I did watch these two, definitely. And then, did some background research. So I want to fully understand what is NAV erosion, because it's one thing to watch a YouTube video and go through their points because, funny enough, both of these YouTubers, and this is not a knock on them, but both of these YouTubers brought their point about what they think NAV erosion is, right? They actually had kind of different points of view of what is NAV erosion, right? So it was interesting to see. I'm not saying they're right or wrong, or one is smarter than the other. I'm just saying that they both brought very unique perspectives to the conversation. So this is going to be my point about bringing, some of my own perspectives or viewpoints, as well as facts, I guess, to the conversation. So let's take a look. So what is NAV erosion? First, we need to understand what is NAV. Okay, so we're going to look at this article from Investopedia, ETF market price versus ETF net asset value, and what is actually the difference. All right. The ETF market price is the price at which shares in the ETF can be bought or sold on the exchange during trading hours. The net asset value of an ETF represents the value of each share's portion of the fund's underlying assets and cash at the end of the trading day. So essentially, the net asset value of an ETF represents the value of each share's portion of the fund's underlying assets. And they give you kind of a formula on how to come to net asset value. The NAV is used to compare the performance of funds as well as to report dollar figures for accounting purposes. Okay, this is going to be really important later. A lot of people misconstrue or they kind of just say that the NAV is the market price, which is not true at all. As a matter of fact, I'm not going to lie, I actually thought the same thing too. I thought net asset value was the price of the ETF, but that is not the case. So I'm not afraid to go out on record here and say that, I didn't know. But here's an example of this. So this is VU. This is the Vanguard S&P 500 ETF. All right, we're just using this as an example of what the net asset value is versus the market price of the ETF. Okay, so we understand what is NAV. All right, so market price, here it is, $560.69 versus the NAV price, which is $560.75. All right, so you see the difference here, okay? So there is a difference between NAV and ETF market price. So that's just something we have to keep in the back of our minds. It's just something we have to be aware of. Okay, so how does dividends affect NAV? So whenever we're talking about NAV and we're talking about net asset values, this affects stocks as well as REITs, right? Or anything that produces a dividend. It could be a mutual fund, it could be a stock, a REIT, anything. Essentially, whenever this instrument, this stock, this REIT, this ETF, this mutual fund pays out a dividend, typically that has to come from the NAV, from the net asset value of the fund or of the company, right? Or the balance sheet of the company. So when they pay that out, the stock price is going to drop just a little bit, right? To compensate for them paying out that dividend to investors. And a dividend is basically a reward to investors for investing in the ETF or investing into that company or that REIT. So we have to keep that in mind, that whenever dividends get paid out, you know, the NAV or the REIT or the stock is going to drop a little bit in price. And the same thing is true for bonds, okay? Bonds and treasuries, all that, it's universal across the board. So let's take a quick look at what all this means. So distributions, let me make sure you guys can see this. There we go. Okay, so distribution of dividends reduces the net asset value of mutual fund shares. However, this doesn't mean the fund investors sustain a loss. Mutual funds, ETFs, whatever you want to call them, invest in a number of different securities, including stocks and bonds. Whenever these securities offer dividends, the fund is obligated to distribute them to shareholders, all right, to people like you and me. The net asset value of a fund declines when a dividend is paid, as it lowers the value of the fund. So this is why compounding dividend reinvestment is so important, because when that ETF or that stock or that REIT, when it drops in price and pays you out that dividend, reinvesting that money back into the company or back into the REIT or back into the ETF, you're able to capture shares at a cheaper price, right? So this is actually bringing, when they also do that, it's bringing the cost basis down, okay? And you want to have a lower cost basis for long-term holds, okay? That is a key point there. You want to have a long-term or a low cost basis for long-term holds. If you have to sell in the future, you'll be paying a larger capital gains on that. Of course, I'm not a CPA. You should consult these people, not a financial advisor, etc. You guys know the disclaimer at this point. All right. So how distributions affect net asset value? We kind of already covered this. In mutual funds, NAV is calculated by dividing the value of the fund's assets by the number of the fund's outstanding shares. When a fund distributes dividend payments to its shareholders, the NAV declines. Shareholders must keep this in mind when attempting to determine how well their investments are performing. Okay, so there is, you know, this is moving into our next point here. There's a lot of conflicting information. There's a lot of perspectives out there, especially when it comes to these covered call ETFs, right? There's some who are just vehemently against anything NAV eroding, right? And I was one of those people. I was one of those people that were like, you know, if this all covered call ETFs, all their NAVs erode, i.e., I'm never going to invest in these things. But there is a proper way to do it, okay? There is a smarter way to do it. So we're going to be exploring that under the ETF stacking portion of this segment, all right, of this stream. So again, we're just learning what is actually NAV erosion. What is there? Again, there's no real textbook definition, but there is just a bunch of information on what NAV erosion is. So let's look at an ETF manager Curve that actually has a bunch of covered call ETFs. Okay, so understanding ETF distributions and types. Let me see. Yeah, understanding ETF distributions and types of NAV fluctuations. All right, so X dividend and NAV erosion. Okay, this is where they talk about it. Before a distribution is made, cash is still held by the fund. After it's been paid out to the shareholders, naturally, this distribution is subtracted from the fund's NAV, which decreases the NAV, right? The net asset value. This is sometimes known as NAV erosion, But this term is based on a misunderstanding of what's happening under the hood. There's no erosion per se. It's just that NAV decreases when distributions are paid out because there's nowhere else for the money to come from. However, if an income-focused ETF's total return underperforms the underlying exposure in a declining market, this could potentially mean that the distributions might be paid out of underlying capital, which can have more far-reaching deleterious consequences on the principle of a given investor. Basically, what this means is, as they're paying out their dividend, right, the high distribution rate, whatever they're paying out, it's dropping the NAV. And this could be bad for investors, right? This could be really bad for investors, is what this is essentially saying. But they're just taking the money from the NAV to pay you, okay? Let's see, where did I stop? Blah, blah, blah. Income generated from the underlying asset in a fund is distributed in a set frequency, and this income usually helps to mitigate the fund's downside risk. If the income distribution is greater than the actual income generated by the assets in the fund can potentially lose greater asset value over time. All right, so I know this is kind of like a word salad. This was a word sandwich, a lot of stuff in here. I will keep all these links down below in the description for you guys so you guys can take a look at it yourself. All right. But essentially the net of this is that whenever a fund goes ex-dividend, or whenever they pay out a dividend, it takes it from the NAV and then the NAV drops. Okay. So now we know this. All right. We've looked at 3 different articles. It's all saying the same thing, that whenever a fund pays out a dividend, the NAV is going to erode, right? It's going to go down, which we as investors, we don't really want. But when you're eyeing down mouth-watering 100% distribution rates, you know, sometimes people overlook that stuff. So we're going to get into that in just a moment. So there's this other thing that happens, right? It's called reverse splits. And again, there's 2 camps to this. There's 2 camps about whether people like this or they don't like this. So on the one hand, reverse splits are nothing more than accounting, right? Some will say it's just for accounting. It's just to keep the ETF from becoming delisted. It's not a big deal, right? Others say that no, it is a really big deal because it is, you know, basically the ETF manager trying to cover their tracks, right? Trying to make their share price higher for a for a declining ETF, for something that is going down in value. So Kurv addresses this, and I like this because they address this, right? Our final topic will be discussion of reverse splits, which is worth understanding before you park your money in an ETF. As their name implies, reverse splits work exactly the opposite of how a forward split works. If an ETF has 500,000 shares, including or trading at $25 each, it could execute a 1-to-2 reverse stock split to have its shares to 250,000 and double its share price to $50. All right. So there are a few reasons for this, why an ETF might execute a reverse split. If the share price declines enough, the fund might risk being delisted, which calamity could be prevented with the price bump achieved through a reverse split. That said, reverse splits are generally not viewed favorably and often considered a warning sign. Market participants should usually interpret reverse splits as evidence that a fund is in trouble and its managers are attempting to inflate a catering share price. And just as stock splits increase liquidity, reverse splits decrease liquidity. All right. So again, as an investor, all right, you have to look at these things you have to look at these ETFs and really ask yourself if you want to be a long-term investor in these things. Personally, at this moment, there's a lot of high-yielding covered call ETFs that you should not be investing in long-term. Okay, and I'm going to get into that here in just a second about when I cover the ETF stack, right, or ETF stacking strategy, which again, I did not coin this term. I don't even know where I got it from. It probably came from one of those videos, probably from Oracle ETFs if I had to guess. Maybe he mentioned it. I know he mentions a lot about ETF stacking, so maybe that's where I got the idea from. I have no idea. But let's keep going with this. All right, so reverse splits, depending on why they're doing it, could be good or it could be bad. But as a long-term investor, as an investor that's parking a lot of money into an ETF that's supposed to provide you income, I don't want a decreasing NAV because that's going to decrease the price, the market price of that ETF. I want to be able to park my money in an ETF and make income from it, right? That's almost like having your cake and eating it too. But on the flip side, when you're really looking at it, I'm trusting a ETF manager. I'm trusting a fund with my money. They're promising me this money in return, this distribution rate, this dividend. So I expect that I can keep my return of, I can keep my dividend, return of capital, whatever you want to call it, and my principal, my principal capital that I just invested into this ETF. So as an investor, that is what I expect, right? That's what any investor should expect. So this is why reverse splits can be bad. You're right. It could be bad. Some will disregard it as, oh, it's not a big deal, right? Which I think is not intelligent, to be honest. All right. So let's go and move on. So let's just look at another article from Roundhill, behind the curtain ETF distributions. Again, I'm going to just put this in the description. You guys can go check it out if you want. I'm not going to read this. You guys already know it's kind of a word salad. Basically, it's saying that it's no free lunch, that if they pay you out a dividend, a distribution from these covered call ETFs, that they're taking it from the NAV, and that's what decreases NAV, and then that's what leads investors to believe and yell NAV erosion, right? But here, we're going to get into the ETF stacking portion, okay? And I'm going to give you guys just a couple of examples, all right, of what kind of like, even though these companies do cover calls and cover call ETFs, they kind of have different strategies. They have, if that makes sense, they have different strategies. They have different perspectives. So I'm going to show you guys two different companies that have the same type of ETF, that do the same type of cover call ETFs, but their outcomes are completely different. So let's look at Tesla. All right, so now we're looking at Tesla. So Tesla, obviously on a rip, doing well, right? Over this last year, they had what, 88% gain, really good, pretty volatile in my opinion, but yeah, pretty good, right? So there is a popular ETF, cover call ETF out there known as tsly, which comes from yieldmax. Okay, over the same period, over the same year, they lost 31% of their share price. Okay. And as we saw, share price and NAV price are pretty closely related. They're not the same thing, but they're pretty closely related. So we can deduce from this chart that the share price and the NAV has went down, right? It's went down 31%. Not good. Not good for an investor. As an investor, if I was investing in this, I'd be kind of pissed, especially if you're holding it for the long term. I mean, if you zoom out, it just gets worse, right? It just gets worse. Yes, they're paying out 100% distribution, but if you do the math and if you really look at how this thing is working, you're really just taking money. Let's say you had $100,000 in this thing, right? You put $100,000 in your right pocket, and then you just take out the distributions and put it in your left pocket. Like you're not making money, you're just moving money, right? So a lot of investors kind of got wrapped up in this and they ended up losing a ton of money. So, but again, we're going to talk about ETF stacking here in a moment and kind of how you can look at this and how you can strategize for your own portfolios. All right. Because at the end of the day, we all want to make money. All right. So we know this. Right? We know this. Over the same time period, they lost. We could look at the distribution rate. Yeah, the distribution rate might have been high, but again, it's probably still not compensating for the fact that your return or that your principal, right, your capital has been going down in the ETF. So let's move on to another ETF manager. Okay, another ETF manager that does a similar strategy, but they have a far different outcome. So this is who we're going to look at. We're going to look at Kurv. All right. This is Kurv Yield Premium Strategy Tesla tsly ETF, ticker tslp. Okay. Same time period. Okay. February 14. And then we look here, February 14, right? Happy Valentine's Day, of course, to everyone. Far different outcome. So what's the difference? This one has a 20% gain, basically a 20% gain over a 30% loss. They're both following cover call strategies. So what's the difference here, right? This is the $1 million question. This is the question that's going to make you the money, right? So for this, we have to really look at the ETF managers and how they're employing these strategies and what their views are and what their perspectives are, et cetera, right? But just a quick back test. If you, and again, this is a great tool. I recommend anyone use this tool. This tool is Portfolio Visualizer. It'll just give you you can back test a couple things, but we're just going to look at yield max and we're going to look at Kurv. Okay, so we're going to compare the two, and we're going to compare it against the S&P 500. So I hope you guys can see this. Okay, so you guys can see this. Okay, so yield max $10,000, Kurv $10,000, and the S&P 500 $10,000. All right. Why are the ending balances so different? You have $12,000 for yield max. You have $13,000, almost $14,000 for Kurv, and you have almost $13,000 for the S&P 500. Substantially less risk with the S&P 500. Substantially less risk. You didn't have to do anything, and there's no NAV erosion with an S&P 500 index fund, right? Now versus yield max not looking too hot. Again, I'm not saying yield max is bad or anything like that. They're not inherently bad or good. I'm just saying that, you know, this raises an eyebrow when you're comparing the two. Okay, so Kurv has a large gain. Okay, so let's look a little further down, and we're looking at income. Okay, so Kurv they only distributed $2,600, almost $2,700, whereas yield max gave out $7,000. Okay, $7,000 in income. That is wild. That is wild. Okay, two totally different strategies here, but they have, or they offer the same cover call ETF, right, product, but the underlying strategies are far different. You know, so again, this just makes you raise an eyebrow. Why is Kurv doing better than yield max? If yield max is producing a higher distribution, right, a higher rate, a higher dividend, why is Kurv doing so well? All right, now for this is where we get into kind of the nitty gritty. Okay, so you have to do a little bit of your research, your due diligence on these ETF managers to fully understand. Now, there's no shortage of interviews for these guys. Howard Chan, I believe his name is. Let's see, Howard Chan. Yes, Howard Chan is the CEO of Kurv. He has a ton of interviews out there. I really recommend you guys take a look at some of them. He's a pretty bright guy, not gonna lie, really bright guy. He did a interview with Oracle ETFs, which I really enjoyed, because the questions were very direct, to the point, straight. You know, they were not cushioned, right? These were not fluffy questions. You know, how are you doing? Oh, you know, what do you like to do for fun? Like, I don't care about any of that. I care about, are you going to protect my money? That's what I care about. And how much are you going to pay me? Right? That's what I really care about. So I would, I'll put a link down below in the description for that interview, or maybe I'll try to link it or something in you know, for a card up here or something. But really recommend you guys go through that whole video and just really look at it, because it is a smart, you know, the way they do their strategies is really smart. I haven't looked at the yield max interviews yet, but I will, and probably report back later on that. So again, we're going to look at TSLP. Okay, we're going to look at TSLP in a second, but let's look at Kurv. And here's their strategy right from their website. Their cover call strategy is cookie cutter vanilla, right? Everybody does this. Yield max, roundhill, Kurv, Global X, all these other ETF providers, they all do this cover call strategy. All right, but here's the difference. The Kurv ETFs, they strike a balance between income generation and potential upside capture in a rising equity market, designed to efficiently gain stock exposure, leaving enough cash to generate additional distribution from interest payments. All right, they have a nice little video here that kind of goes over that, but this is a big deal. They want the upside of the underlying security, right? So for us, for our example, we're looking at Tesla. They want to be able to capture those gains. Again, if we look 1 year, why are they so different? Okay, why are these so different? And then you look at these two, same strategy, Why are they so different? And this has to do with Kurv's, you know, strategy to include income appreciation in their covered call ETF versus just paying out a ton of distributable, you know, income to investors. All right, so let's look at TSLP. So TSLP, this is the Kurv Yield Premium Strategy Tesla ETF. All right, let's see. Okay, you guys can see this 51% distribution rate versus Tesla's 100%, I think. Oh no, 77%. All right, so difference, big difference here. All right, enhanced income, potential benefits of Kurv Yields Premium Strategy ETF. Enhanced income strategies focused on generating monthly cash flow through diversified multiple sources, including harvesting covered call option premiums, dividends, and interest income. Dynamic optimization. This is where the magic is, right? The dynamic optimization is a balance between income and capital appreciation potential in certain rising markets. Now, they're not always going to get it right. Obviously, they're not always going to get it right, but they've been doing a pretty damn good job, in my opinion, if you look at these two, right? If you compare these two. Again, yes, you're sacrificing the higher distributable rate from yieldmax, as we clearly shown you here. You're sacrificing the higher income, but you're getting capital appreciation, and you're still getting a very modest, decent, you know, income from distributions. I would find that very attractive because you're getting an appreciating asset. You're getting an asset that's, you know, appreciating, even if it's a little bit, and they're still paying you out money. So they're protecting your capital, which is a big deal, a very big deal, guys. All right. If I'm an investor and I'm putting money into anything, I want to make sure two things happen. One, I get cash flow, and two, my principal, the money I just put into this asset, is not going to evaporate in thin air, right? And I get the whole, oh, it's a return of capital, the yield, all these funds are paying you the money. Okay, take that same $100,000, that same $10,000, put it in your right pocket, and then every month just take $10,000, put it in your left pocket, right? You're now paying yourself a high distributable rate. Again, it's not, yeah, I can go on and on about this, but the math doesn't math sometimes. So this is why this is so important. You have to understand the ETF managers, what their strategies actually are, and how they are going to benefit you as the investor. Okay, they pay monthly, which is good. 51% distribution rate, awesome. Let's see what else. You know, their expense ratios pretty much the same, in line with everyone else. You know, almost a percentage point. Okay, so let's move down again. Market price $25.79. Net asset value $25.81. The NAV is higher than the share price. All right. Again, we're just using this as an example to make you guys aware that ETF market price versus ETF net asset value is not the same. Okay. All right. So, yeah, the rest is the rest, right? You guys can look this stuff over. Again, I'll include links to this in the description for you guys. All right. So let's look at tsly, okay, from yieldmax, high distribution rate. Okay. High distribution rate. The fund does not invest directly into Tesla. The fund strategy will cap its potential gains if Tesla shares increase in value. The fund strategy is subject to all potential losses if Tesla shares decrease in value, which may not be offset by the income received by the fund. This is right off their own website. Like, this is right off yieldmax's website. I'm not saying this is good or bad. I'm saying this is their strategy. Okay. They cap the gains, obviously, because that's how the covered call strategy works, right? You're going to cap at one point, right? You may not be able to capture all those other gains in a rising market, but you certainly will feel the pinch if that underlying security, if the market as a whole takes a nose dump, you know, dive, goes down, not nose dives, whatever. You're going to feel that, right? So we just have to keep this in mind. And again, here under fund overview and investment objective, and I covered this again in prior lives and prior videos, but for you guys, we'll just cover it real quick. The yieldmax tsly option income ETF tsly is an active managed fund that seeks to generate monthly income by selling, writing call options on Tesla. tsly pursues a strategy that aims to harvest compelling yields while retaining cap participation. This is the key words right here: capped participation in price gains of Tesla. They are not looking for capital appreciation, okay? Not looking for capital appreciation here. Investment objective. The fund's primary investment objective is to seek current income. All right. Well, whenever I see these words like current income, I'm thinking like probably short-term stuff. Okay. I want money now. Holding this long-term may not be the best wise use of your money. Again, we're going to be talking about ETF stacking here in just a moment. All right. And I think this ETF stacking stuff is probably a very, intelligent, genius way of doing covered call ETFs, especially if you're not a trader like myself. I'm not a trader. I never traded. Well, I can't say I never. I mean, I never did like options or anything. I tried to do swing trading and that blew up in my face, right? So I always adopted this approach of being a buy and hold long-term passive investor. Covered call ETFs are a nice blend of actively trading, right? But doing it passively. I'm literally outsourcing my trading to an ETF manager that's going to do it for me. This is why I like this ETF stacking stuff, right? Anyways, the investment objective, the fund's primary investment objective is to seek current income. The fund's secondary investment objective is to seek exposure to the share price of the common shares of Tesla, subject to limit on potential investment gains. Okay, so we know this already. This is pretty much explaining the difference between these two, okay? Tesla, they don't really care, right? They don't really care about capital appreciation or even capital preservation, right? They really do not care. What they care about is paying out high distributable rates of income to you as the investor, which explains why they pay $7,000 and then Curve only pays $2,700, right? So big freaking difference. But if we look at the share price difference, far different, right? Far, far different. Up almost 20%. And for a point, you know, for a time, it was up 51%, right? These are the points where you got to like kind of tell yourself, does it make sense to get out, maybe shave a little bit, you know, take some gains, some chips off the table, and then reinvest that into something else, right? This is at these points where you should really think about that. And you know, this is where you have to kind of have your own rule set of covered call ETFs. You know, if they reach a certain appreciation level, you know, to shave the top part, right? To shave the profit, to take some chips off the table, right? I heard and I read this as being known as profit ripping, which I'm doing a little more digging into. But profit ripping is essentially the idea behind this. And I like that, I guess, that phrasing, right? Because it makes perfect sense. All right, another shout out to Oracle. All right, so let's move on. So what is ETF stacking? Okay, we're going to move on to ETF stacking because I know that's what you guys want to see. So instead of showing you all these nice little charts and all this, you know, portfolio diversification, you know, using pie charts and things like that, I think the best example I can show you is going to be this right here. Okay, this is basically ETF stacking in a nutshell. Let me see if I can make this a little easier for you guys to see. Okay, I think that's good enough. Okay, so this is ETF stacking. All right, and this is going to be the strategy that I'm going to employ in my own portfolio at some point. I just haven't done enough research, enough due diligence yet, but this is the idea. Okay, this is the structure. This is what I plan to do. Okay, and again, just looking at all the different types of perspectives out there, not prospectuses, you know, from ETF managers. I'm talking perspectives, viewpoints from different investors. Again, and I hate to make it seem like I have a massive man crush on this guy, but I'm telling you, Oracle has a great idea, and he shows it in his actual portfolio, and it makes so much sense, right? And I think as a prudent investor, should you go 100% into this ETF stack? Probably not. I think I would err a little more on the side of caution. I would definitely include, you know, some type of S&P 500 variant or some type of ETF, you know, stable ETF on the outside, you know, to basically diversify against the covered call ETFs. But again, it's not wrong or right. It's just two different perspectives. It's just two different viewpoints. But there's nothing saying that you can't include something like a covered call ETF strategy in your portfolio. So that is what I'm doing. I'm including that in, you know, on top of the real estate investment trust that I own, on top of you know, the index that I own, et cetera, et cetera. So this is ETF stacking. All right. And I labeled them risk, medium, low, and high. And honestly, the colors should be, green should be up here and these should be yellow. But anyways, we'll call this gold, right? This is gold. All right. So the whole point of ETF stacking with covered calls, ETFs, is to make money, is to generate income. All right. So this is how you can do this. All right. This is, and again, this is not mine. I did not create this. I found this and this just makes the most sense. So you can start off with roundhill S&P 500 0 DTE cover call strategy. Why would you start off with this one? All right. Because there's price stability. There's no NAV erosion as of now. Okay. As of now, there's no NAV erosion. There's moderate income, and this could be a good cornerstone for the portfolio, for the sector, right? For the section, right? You can hold this thing long-term right now. Hopefully Roundhill doesn't screw that up. And the reason why I say that is because if we look at xdte, this is over a year, right? This is from March 8th, 2024, when this ETF came out, all the way to today. It's only had a 3.14% decline, but it's paid out a lot of money. As a matter of fact, let's find out how much money it's paid out, because I don't want you guys thinking I'm just making crap up. Okay, so 26% distribution rate, 26%. Okay, that's on top of not losing any money. Okay, you lost what, 3% of the NAV, of the market share price. Not a big deal, in my opinion, if you're getting 26% in a distribution rate. All right, again, this is the Roundhill S&P 500 0 DTE cover call strategy. So it's writing cover calls against the S&P 500, which if you guys don't know, or for new subscribers, new viewers, the S&P 500 is a basket of 500 of the largest US-based companies in the United States. All right. So when you put $1 into an S&P 500 index fund, you're basically diversified across 500 companies. So unless all 500 companies go into the toilet, you know, your money's not going to zero. So doing this strategy, a cover call strategy against the S&P 500, in my opinion, in my eyes, you know, it lowers the risk. It lowers the volatility by quite a bit, right? It's just a safer, and I use that word lightly, but it is a safer way of investing into cover call ETFs. All right. So we know that this manager, as of now, I haven't found anything, you know, saying otherwise, but xdte is doing very well. Okay, so this would be the stability, right, of the portfolio. This would be the stable piece of this. Okay, let's call this, I don't know, let's call this 60%, right? This is 60% of the portfolio off of $100,000, right? You're getting 60, you know, you're putting $60,000 into this. As a matter of fact, I wish I did the math so I could show you guys how much each of these would produce. Maybe I'll do it in another video. But anyways, this is going to be a price stable, moderate income, long-term holding. All right. This is what we want. We want this to be the basis of the cover call ETF investing strategy. Then you move into price appreciating assets. Okay. These are again, you're still medium risk, right? Still a little more medium risk. You could technically swap these two. You can swap, you know, Roundhill for Kurv, you know, if you really want that appreciation. But I want to put Kurv here because these are probably going to get swapped out every now and again. Okay. Not as much as the yieldmax stuff. And again, you replace the names, right? This could be anything. This could be Roundhill. This could be Kurv. This could be GlobalX. This could be yieldmax, but it's the fundamentals that you want to look at. You want to look at for price stability, moderate income, long-term holding, you know, perspective. Okay. For Kurv, I want NAV appreciation. I want moderate to high income, and this will be a medium to long-term holding. Whatever medium to long-term holding means for you is going to be different from me. For me, definitely at least a year, right? This will definitely at least be in the portfolio for a year, if not longer. If they continue to be good stewards of my money, then I will definitely keep them much longer. If I don't get NAV erosion, right? NAV erosion or NAV depreciation, if I don't get that, then I'm going to keep Kurv much longer, you know, longer term, and I'll probably keep putting more money into these assets, right? They have different ones. You have Tesla, you have Netflix. I just chose these two because they're kind of the hottest ones right now. But they have Google. They have basically the Magnificent Seven. I think they're missing NVIDIA or something like that. They're missing one. I'm not sure which one, but they are missing one. Then you get into the higher risk plays, right? So you get into the high risk stuff. And this is where you're going to put, like, out of 100, hypothetical 100,000, 60,000 is going to go to roundhill. Probably, let's see, 15 to Curv, another 15 to Curv. And then you'll probably do 5 and 5 to yield max. I think that equals 100, right? No, 10 and 10. I think 10 and 10. Yeah. Or 5 and 5. I don't know. You guys know what I'm trying to say. But yes, these are the highest risk positions. This is what you're going to put, this is where you're going to look for opportunities. This is where you want to look for something that's a momentum play. So there's a potential for NAV appreciation. Okay, this is a big key word here. Potential for NAV appreciation. It is a momentum play. It's in the news. It's hot. Everyone's talking about it. You're seeing it on Facebook. You're seeing it on social media. All the YouTubers are talking about it. Everyone's saying how great this is. This is going to be a wealth builder. There's a lot of YouTubers out there who are like, oh yeah, SMCI is the wealth generating stock of the century, yada, yada. I don't believe in any of that, to be honest. I have my own biases against why I wouldn't invest in SMCI, but I would like to make money off SMCY or SMCI and the volatility it has. So this is why I would employ a yield max income strategy ETF, right? It's a momentum play. There's high income because if you look at if you look at SMCY, the distribution rate I think is nearing 100%. Last I checked, I could be wrong, but it is very high income. But this is going to be a short-term holding. Once the momentum wears off, once the glitz and glamour wears off, get out of it. Get out of it. You can profit rip off of it. You can take some profit, some chips off the table, whatever you want to call it. You can take some of that money off and reinvest it or hold it and then, use it for another play or whatever, right? You can do that. For the distributions that it produces, you can also hold that money and put into probably one of these other guys or, I don't know, pay off margin, whatever it is, right? Whatever you want to do. But these are the higher risk, high momentum, potentially, potential for NAV appreciation holdings. These are the very short risk ones. These are like the 0 to 3 month holdings. You're in and out, right? Like a bank robber. You're going to hold it for a little while. You're going to swing it, make some money off of it, and then get out of it. Now, all of these, okay, again, I'm not a CPA. Don't come after me. I'm not a financial advisor. But all of these are going to have their own unique tax consequences. So just be aware of that. It's not about just making a bunch of money and then calling it a day. Uncle Sam's going to want a piece of that pie. So just remember to keep that in the back of your mind whenever you're employing a strategy like this, okay? Because there are tax consequences. There will be tax burdens. All right. And please don't be like these guys who are like, oh, well, I'll just use the distribution, the dividend to pay for my taxes. Like, come on, guy. Be a little more prudent. Be a little more thoughtful as an investor. Don't be a degenerate. Like Uncle Sam has so much reach over you and resources that he can use against you that you don't want to be in a tax fight with him. You will lose. All right. Period. You will lose. So anyways, with that disclaimer off the table, this is ETF stacking. This is the idea behind the cover call strategy that I'm going to be employing in the portfolio at some point. I'm just, again, doing some more background research. This to me looks like it's going to be the best way forward for employing a cover call strategy. So with all that, guys, let's look at the poll. We covered a lot in this stream. We covered a lot, and we're already at minute 43. We covered a lot in this stream. Let's take a look at the poll and see what everyone's thinking. Okay, so the question was, do you invest in high-income cover call ETFs? 62% said yes. 38% said no, off of a total vote of 8 people. All right, so I'm going to go ahead and end that poll. And I appreciate everyone who came in. All right. So just taking a quick look at the comments. Oracle, fast money trader. Man, let's speak of the devil. Speak of the devil. Hey, sir. Hope all is well on your end. Hope you had a great Valentine's Day. Guys, if you're not subscribed to his channel, you need to check his stuff out. He's fast becoming one of my favorite cover call ETF investors. All right. Because it's just, his stuff is just, it's really, really like in the weeds. It's really, really good stuff. Okay. Yeah, I can't speak highly enough of it. Anyways, Danos, what's up, man? Welcome back. I don't have any more things to cover, guys. This was pretty much the stream. I just wanted to really get this ETF stacking stuff out, this whole NAV erosion, this whole idea of NAV erosion out. Again, there's no textbook definition of NAV erosion. It's something that was thought up by a bunch of investors who started posting probably on Reddit, and then, you know, fund managers and things like that are reading these posts and they're like, oh crap, like NAV erosion is a real thing. And then it just kind of spread, you know, viral across the interwebs, and now everyone's talking about NAV erosion, right? Because up until this point, and I've been investing for, I don't know, since 2016, 2017, I never once heard of NAV erosion. So it was really interesting to hear NAV erosion and then actually experience it when I invested in the YLDs. So I invested in QYLD from Global X, RYLD, and XYLD. And that's where I actually like got to witness firsthand NAV erosion, because my capital was basically eroding in front of my face. So that will do it for this entire section. That will do it for this stream. Unless anyone has anything that they want to talk about, how did you guys enjoy the stream? Did you guys like the stream? Did you guys get a lot of useful content out of the stream? Did you guys get a lot of useful information out of the stream? You know, let me know, because I'm genuinely interested. I plan to do probably another video, not on NAV erosion, but on something called, and again, I didn't coin this term, but it is pretty genius. It's called margin stacking. So I plan to do a video on that, and I'll probably do a nice little chart like this. Again, Oracle's the one who came out with the idea of margin stacking. So I'm just going to put a kind of a picture against it, because I use my margin, but I didn't use it in the way that he's using it for covered call ETFs. Instead, I used it for real estate transactions, right? For investing into real estate and real estate projects. So that's what I use my own margin for. But using it for covered call ETFs sounds exciting, but again, it has to be done in a right way. And I think the way I'll explain it with you guys, on top of using ETF stacking for covered calls, you know, aside from this, there's going to be one extra layer at the very top. There will be an extra layer at the very top, which will be the pinnacle of stability, right? And then you could basically use margin and then invest into a margin stack, or into a ETF cover call stack like this. So no reply, guy. Well, you replied, sir. So I'm gonna take your name. Found out about your channel from Oracle ETF. Awesome, man. Welcome to the channel. Hope you got to see the entire stream. Hope you enjoyed it. Especially with this NAV erosion stuff. Like it's crazy. Like everyone, like all these guys, and I'm not here to bash them. All right. I just want to make that clear. All these guys all had like difference of perspectives of what NAV erosion was, and they're all good. Like they're not bad, but they're all pretty like informative. And it was just interesting to see. And as you kind of go down the whole rabbit hole of what it is, like first we need to define what NAV is, right? And there luckily is a textbook definition for this, so we don't have to do much work. And then you just kind of go down the rabbit hole of what is NAV erosion. And it's nice. I think it's nice that Kurv and Roundhill are nice enough to kind of explain that, right? They at least include an article of what NAV erosion is, or how they understand NAV erosion, which I think is really cool, because, you know, it's kind of like one of those things where, you know, the manager of these ETFs, these financial instruments, you know, they don't want to air out their dirty laundry. So the fact that these guys are blatantly just talking about it, you know, kind of, you know, increases my trust in them and their product, which at the end of the day, trust is a big deal, especially when you're handing over a bunch of capital to these managers, right? Same thing goes in the real estate space. If you're investing in real estate, you know, and you're investing with a team of people, you definitely want 100% trust that you're putting your money in a good project, right? With a good team behind it, right? Trust is a big deal. Yeah, I can go on and on about having mistrust, but I will skip that for another day. So yeah, guys, I think that'll probably do it for this stream. We're at minute 50. Unless anybody has anything, any feedback, any comments, anything at all, I think I'm going to go ahead and call this stream. I know you guys are probably enjoying your time with your loved ones. It is Valentine's Day. So if you're watching this or listening to this, you need to close it and go hang out with your loved one, right? Go hang out with your girl or your husband, whatever. I don't know really who my audience is right now. But again, I think this was a great video. This will probably be one of the most important videos I've made on the topic, especially since I'm going to be implementing this strategy in my own portfolio sometime in the future, just waiting for it to happen, right? I gotta basically find the capital to make this happen. I could sell out of a couple things, which I'm thinking about. So we'll see how that goes. Danos, good question. Why not all yield max? Simple. Yield max does not have a good track record of, and I'm not bashing them. I'm sure they have smart people. All right. They have really smart people. I definitely can't do what they do, but as an investor, this is what I see. A lot of their funds are in the red. More than a lot of their funds are in the red. All right. When we're just talking about strict ETF price, price tags or whatever, right? We're not, NAV, etc. They're all pretty much in the red. You can search some of these if you'd like, but if you really go down the rabbit hole, you're going to find that a lot of these are all red. And again, as I covered, you want to have, if you're going to invest in these things, you want to do a short-term position, right, in these yield max funds. Okay, you want to do a short-term position in these yield max funds. You want to basically ride the momentum of these, right? So right now, like msty was all the rage for a little while, right? And it looks like it's going down now, right? It was all the rage, distributions high as hell. Everybody was talking about msty. All the YouTubers talking about msty. There was all like msty this, msty that, right? And now it looks like the NAV is starting to go down. So would now be a good time to get out of it? I don't know, right? I'm not saying yes or no. I'm just saying would now be, asking the question, would now be a good time to get out of msty? But if we look at something like Palantir, right? Let's take a look at Palantir. Palantir stock. So Palantir has been going crazy this year, right? It had a huge spike, as we all saw and we covered, right? 20%, was it a 20%? Yeah, 20% jump, and then it's just been going up, right? All because of the whole AI play, the whole, thesis behind AI, the current Trump administration and his favorable, favorable viewpoints on AI and creating conditions that are favorable for businesses to innovate for AI. So Palantir just spiked like crazy on top of, having a great earnings. And if we look at plty, whatever, I don't know. If we look at plty, we can see that they also are going up, right? They've only been out less than a year, far less than a year, but they've been increasing, right? Who knows what's going to happen? But if we look at tsly, and again, I already covered tsly, not doing so hot, right? I think, let's see, not apply. Let's look at another one. Let's look at GUI. Let's see how GUI's doing. Again, not doing so hot, right? But if we look at something like Goop, right? This is from Curve, doing pretty well, right? They're both employing the same exact cover call strategy, but one focuses on capital appreciation. The other one focuses on distributable income. Okay. So this is why I wouldn't do a whole portfolio of yield max ETFs. There are investors who do nothing but yield max ETFs, and I think that is the stupidest thing to do, the dumbest thing to do, right? And this was what made me vehemently against cover call ETF investing in the beginning. Comment from Eugene for Harmony. Eugene, would like to comment as you speak, but my 2 cents. I think they switched from monthly to stacked weekly. Not sure how it works. Happened last month. I mean, Curve did. Awesome. Yeah. Curve. I think I saw that too. And again, I just like how Curve has been responsible thus far. If they start becoming irresponsible, then I would just get out of them. I'm not even in these ETFs right now. All right, full disclosure, but I'm talking from a point of like as if I was already investing in these things, because I do plan to. I don't know which ones. if I had enough money, I would invest in all of these, but you know, I don't think that'd be a prudent use of money, especially when you're trying to, you know, concentrate in a couple different holdings and then make a lot of income so you can do stuff with that income, right? But you know, if you wanted to do like, if you wanted to make money off the Magnificent Seven, you could, in theory, buy each of these, right? They're missing one. I think they're missing NVIDIA. Yeah, they're missing NVIDIA. You could almost buy all of these, you know, maybe equal weight them and then just collect income off them, right? And then you would never lose your money. So far, you would never lose your money according to their price charts, you know, and you're making some decent income. You know, not as high as yieldmax, but you're also not losing a ton of capital, which is, in my opinion, like I said, a huge deal. So we'll see. Also, guys, if you guys missed the other stream, another website I would highly recommend you check out. Is it Might Yield or Yield Might? No, not Mighty Networks. I would highly recommend you guys check this out. I'll put another link in the description for anyone who missed this. Yes, on the other stream, the last stream I had. Any minute now. But this is a website that was developed by another YouTuber slash investor in high yield covered call ETFs. I think it's a really great thing. Don't forget to buy her a coffee, guys. Like this is such a great tool to have instead of using spreadsheets, charts, and portfolio back tests and portfolio visualizers. Like this is such a nice test. If you put a hypothetical $10,000 into, I don't know, let's go with Curve and let's go with yieldmax, right? These are each of the holdings. These are the weeklies, right? Group A's, B's, C's, and D's, and then the monthlies, right? And it'll tell you how much you're making weekly, monthly, and annually. Again, I think this is really a really cool tool, and it'll help you kind of, you know, design your portfolio. But again, you have to keep in mind that, you know, distribution rates, they do change. So just because today they're, you know, offering you $117 a week, that could change next week to $119, or it could change to 100, right? We don't know. So just keep that in the back of your mind. But guys, we are at the top of the hour. Again, we covered quite a bit. We covered a lot. I hope you guys got a lot of value from this. But I'm going to have to end the stream. I got stuff to do. Got to hit the gym, right? Got to be healthy, continue my 2025 goals. Again, this is February, all right? We're in February. We're in the middle of February. This is the second month. Are you guys reaching your goals? Are you guys still pursuing your goals? Make sure you're, you know, consistent at least, all right? If you missed the gym 3 times out of the week, don't miss it the next day, all right? Get back on track. But other than that, guys, appreciate you guys joining the stream. You guys know that without you, this channel wouldn't exist. Nothing here would be, I would not be streaming, right? I wouldn't be doing any of this. So you guys are incredibly important, and I appreciate your support, and I appreciate you guys showing up and commenting and things like that. So other than that, I will see you guys in the next stream. You guys have a great night.